Let's talk more about the economic fallout we may face from tariffs. Assuming the China and Canada ones go forward, who knows if Mexico will join? My next guest says there's one key player less likely to cushion the blow this time around. Let's bring in Dean Maki. He's the chief economist at 72's Asset Management. Dean, I feel like I heard Steve Cohen sounding a little bit more bearish lately, too, but you don't need to get into all that. But, you know, as someone, you've been very constructive and very correct about the U.S. economy the past couple of years. I sense a bit more nervousness in your outlook for this year.
I am more cautious at this point than I have been over the past several years. And one key reason is that consumers are, if tariffs are put in place the way we think they will be in some form and at some point, that is going to cost consumers significant amounts of money. And one of the linchpins of this economy has been very strong consumer spending. So that's going to undercut that to some extent. How much, of course, depends on how big the tariff increases are. The second thing I would highlight is the uncertainty that you were just talking about. You know, for example, if you're thinking of building a plant in the U.S. and you're going to import some goods and you're going to export other goods, what prices, what tariff assumptions do you make about any of that? You know, it would have been the case that with the free trade agreement with Canada and Mexico, you can just know what those are going to be. Now, I don't know what anybody puts on those tariff assumptions going forward. So I think that is going to weigh on business investment spending. And that, to me, makes for a much more cautious U.S. outlook for both consumers and for businesses. Especially,
you know, if the Fed isn't there. So this is a point. Dave Zervos, obviously, you know, Dave, he's very optimistic about this whole situation, thinks deregulation will overwhelmingly still provide a positive economic force. But even he, in his note this morning, said, you know, the Fed may wait. They might not kind of move in the moment that they sense weakness. They might think there's more inflation coming, whether or not it actually comes. And, you know, markets like it better when the Fed's kind of right there, ready with the next rate cut. And he says, and I'm sensing you think the same thing, that they're less likely to cushion the blow now than they did in the past.
I think that's right. You know, people think back to the 2018, 2019 experience, and we did have a contraction in U.S. manufacturing. The economy slowed, the Fed came in and cut rates. And so that may be in the back of people's mind. But what I would highlight is that was a very different environment for the Fed. Inflation was below target, so they didn't mind pushing inflation up a little bit with tariffs if that happened. Now inflation is above target for the Fed. We've just been through a couple years of very high inflation. So what the Fed's worried about is that if consumer prices do go higher with tariffs, then inflation expectations may start to rise in a significant way. And the Fed really doesn't want that to get out of hand. So they're going to be much more cautious now about stepping in and cutting rates if growth does slow down in response to those tariff increases.
Yeah, which makes the data points, you know, consumer inflation expectations, which are kind of at high levels, you know, kind of the cycle highs, let's call them already. So if I'm the Fed, you're saying I'm going, well, inflation expectations are high. We're going to get near-term upward pressure on the CPI. I don't want to be cutting in that environment. But do you think they should be, right? Like is this kind of enough of a disinflationary force in the longer run, maybe with some help from, you know, what they're doing on the deregulatory piece, that ultimately that cuts are the right move here?
I don't think the Fed knows that, and I don't think we really do either. What we do know is that prices are going up in the near term if tariffs go in place. You know, that at least the prices of those goods that are tariffed aren't going to go up in price. So what the Fed knows is that there's an upside inflation shock coming of some extent in duration. What they don't know is how long that'll last and what the growth implications of that will be. So I think what we heard from President Collins this morning is how the Fed is likely to react to it. Let's just wait and see what happens. Why do we want to try to get ahead of this when we don't even know what the policies are going to be? And, you know, we just have to wait and see.